Hi, everyone. In this particular section, we would like to discuss broadly what are the characteristics or the attributes or features that we need to have, while we are preparing consolidated financial statements. I mean, these are the key aspects that we need to remember, from a accounting policies perspective, from a consistencies or uniformities perspective is something that we want to talk about here, right? The general features of consolidated financial statements, many of these something that we have already talked about. Yes, we are talking about a single economic entity, right? So the entire group is basically a representation of a single entity, okay? We need to eliminate intra-group balances, something that we have been talking throughout, right? Elimination of intra-group transactions. Also, we would be talking about elimination of unrealized profits. It also needs to be seen, by the way, there could be entities which have different reporting dates, different reporting periods. So how do we bring that same year end into the picture as a question? Of course, the important point further is to have uniform accounting policies in place, right? Essentially, we are saying the parents' accounting policies, right? They need to be followed at the group level as well. That is something which is the expectation, right? So uniform accounting policies are all about that when a parent is preparing the group financial statements, they need to ensure that at a group level, there are similar accounting policies followed, right? In case any member of the group uses some other accounting policies, then they need to kind of make adjustments for these the differences, for example. So it could be an argument here that the parent entity, for example, is following a cost model for its property, plant, and equipment, but a subsidiary is, for example, using a revaluation model, for that matter, for its specific items under property, plant, and equipment. We need to reverse these adjustments in the while preparation of the group financial statements, right? We're not saying that the subsidiary needs to change its accounting policy. Please do not get us wrong when we say that, right? Subsidiary does not need to do anything, right? But from the group's perspective, right, it has to be the same accounting policy as followed by the parent entity. So the consolidation adjustments will be made to create a group financial statement, or to create group financial statements which work on the same or uniform accounting policies there, right? So be very, very careful about it. You're not expecting the subsidiary to change its accounting policy at all. You are simply expecting the group to be following the same accounting policies for the consolidated financial statements, only for consolidated financial statement preparation purposes. Okay, let's take a small example here. It talks about Moon Limited is a parent entity, has a controlling stake or investment in Star Limited, thereby Star becoming its subsidiary. Now, both entities prepares their financial statements using Ind AS. As far as the PPE is concerned, Moon Limited is using a WDV method. The Star Limited is, of course, using, for example, the straight line method. The question is that which method should these PPE be depreciated in the group financial statements? Now, before we even talk about the uniform accounting policies, the first question that we want to understand are depreciation methods a part of accounting policy, first of all, or are these purely derived on the basis of the expected usage, right? Of course, it is not an accounting policy to use a straight line method for one category of asset, or a WDV method, or a written down value method for another category of assets, right? So first of all, it is not two sets of different accounting policies. Okay, so this question itself does not give the information that we are seeking. It's rather a tricky question to confuse us. So simply, it does not make a difference. It's all about the expected usage that we want to kind of emphasize upon, and that's something which we need to kind of be very comfortable talking about. It says that the entity selects the method that most closely reflects the expected pattern of consumption of future economic benefits, right? And that would be applied consistently, right? Unless there is a change in the behavior or the expected pattern of consumption, right? And accordingly, an entity can use different methods of depreciation for different items of property, plant, and equipment subject to the consumption pattern there, okay? And of course, that needs to be borne that it should not be changed if an entity within the group, let's say a subsidiary, is using a different method because the expected pattern of usage or consumption is aligned to that method. That is not expected or required to be changed at a group level either, because even at a group level, the expected pattern of consumption is just the same. Okay, so that's where we're trying to say that you would continue to, let's say, use two different sets of methods, straight line for one and WDV for another, as far as this given scenario is concerned. All right. Let's have a look at the other concept where we say that what if there are potential voting rights and there is a dividend received from a subsidiary? Okay. Importantly, you need to be remembering that, right? You need to be taking care of when there are potential voting rights, or there could be, for example, let's say, derivatives or, convertible debt, etc., which are offering, potential voting rights eventually in future. Okay. They would be, considered for determining whether there's a control or not. But as far as the profit sharing is concerned, right? As far as the dividend distribution is concerned, that is purely based on existing ownership interests, as it should be as well, right? I mean, if I'm owning 70% stake in a company and I have a potential voting right of another 15%, let that 15% come to me first. Okay, let that 15% become mine, and then only the change would arise in terms of what attributing to me and what is not attributing to me. Okay, so that is something that you want to remember categorically. A potential voting right could be critical in determining whether you have control or not, but it has no bearing as far as your share of profit or a loss is concerned, at least from the subsidiary, right? So that has to become an actual share before it can be argued that this is your amount, for example, right? Similarly, any dividend that you expect to receive, you would only recognize dividend when it has been offered to you as a right of receipt of the payment. When that is established, and this would normally be the case when, for example, in the annual general meeting, the shareholders have approved for that particular dividend, and it is likely that the benefits would be arising to you and the amount can be measured reliably. So in your examination, you would normally be seeing whether this is available to you or not, right? So be comfortable about this part altogether. Okay. Now, importantly, you want to remember also a dividend received by the parent company is a part of a group transaction, right? Which means eliminate that income. So if you're showing an income which is received or receivable from the subsidiary, you cannot recognize that as a part of your group's income. That's something that you want to remember. Okay, that's basically the context that you should be very, very comfortable with. All right. Right. This is something that we have discussed when we started the conversation around how to prepare a group balance sheet. We are saying that the assets and the liabilities of the group are basically the combination of the assets and liabilities of the parent and subsidiaries together, right? Equity of the subsidiary is cancelled out, right? So that is something which is cancelled out against the investment made by the parent company. Okay, so that is something which is eliminated and not shown separately. As far as the new line items are concerned, you would have a goodwill or a capital reserve, right? Very likely a non-controlling interest for any shareholding less than 100% stake in the other company. Okay. Also, Parent's share in the post-acquisition profits becomes a part of your, of course, equity, right? It's both your retained earnings as well as the OCIs. They would be coming to you as a parent, right? For all the post-acquisition share of profits. Okay. Now we would be dealing that as well in case a company makes two or more investment in another entity at different dates. It is likely, you're talking about, let's say, a step acquisition. The consolidation would only happen when you control. So let's say if you're having 10% stake earlier and then it becomes, let's say, 80%, then you don't have to worry about 10%. You don't consolidate because there's no subsidiary relationship, right? There's no parent subsidiary relationship. It's only when it has become 80%, when you have a controlling stake, then you consolidate, right? Now, how do we do the accounting of those is something which we deal with under the step acquisition. Okay. As we said before, goodwill is only computed once control is obtained, and any previously held interest, again, in the case of step acquisition, right? These stakes are fair valued and the goodwill, etc., would be calculated on the date of the control there. Okay. This is something, again, we discussed very comfortably. All your intra-group transactions, all your intercompany between the parent and the subsidiary, they would be cancelled in and out, completely, they would be eliminated, right? So any intra-group balances or transactions also resulting in unrealized profits should be eliminated. Okay. There could be a liability in one entity versus asset in another entity. They should all be cancelled, right? Similarly, sales made by one entity would be the purchase, so they would also be cancelled. This is from the P&L's perspective. And similarly, any unrealized profits, etc. We would be discussing all these aspects, with the help of several examples to understand what exactly is the flow, right? This would apply to the fullest, irrespective of the fact whether you hold 100% stake in the company or less than 100%. Till the time there is a control, you eliminate all the transaction in full. Okay. Likewise, we talked about, of course, the references of elimination of unrealized profits or loss. What you need to remember here is always remember who is the seller, right? The seller would have profit or loss in his statement of profit or loss in his accounts, right? And of course, who is the buyer? The other party will be the buyer. That entity's inventory will include that unrealized profit. Okay. So what we intend to bring here is importantly, right? Whatever is your unrealized profit or loss, you reduce the profit of the seller and also you reduce the inventory of the buyer. This is something which is the thumb rule as far as elimination of the unrealized profit is concerned. Something that you want to be very, very comfortable with at any point in time. Profit of seller and inventory of buyer only applies for a parent subsidiary relationship, right? It only applies to a parent subsidiary relationship. Okay. So what I was saying here is basically when you look at any such inventories being transferred. So you look at it when a group entity sells goods to another, the selling entity is a separate legal entity. It records, for example, the profit on sales. And if these goods are still held by inventory by the other entity, which is the buyer. So from that company's perspective, there is a inventory which is inflated. So that needs to be adjusted. It's a similar case as far as the transfer of non-current assets are concerned. So it could have happened that one entity sells a machine to another entity, right, at a profit, for example, right? So to that extent, that adjustment has to be made in the profit which is arising in the books of the seller. But on the other hand, in the books of the buyer, the machine's value is inflated. So that needs to be reduced per se. So there are some questions that we want to discuss, to understand this better in terms of what these perspectives are. But broadly, this is something you need to be comfortable with. It's a similar treatment. You do it, for example, for the unrealized losses as well. Less tested in the examination, but should be very comfortable understanding the concepts per se. Okay, let's have a look at this example. It says that ABC holds and owns 70% of voting rights in PQR. PQR has sold inventories to ABC for 50,000 and has made a profit of 20,000. The inventory is still in the books of the parent. The question is, what is the accounting treatment for the intergroup sale transaction? Provide the journal entries for the sale. Now, there are two things that you want to remember very, very importantly. The first thing is there is a intragroup sale and purchase. They both need to be eliminated in totality, right? But at the same time, in the books of seller, okay, there's a profit of 20,000, which is not yet earned by the group, okay, which means that in the books of the buyer, the inventory is inflated to the extent of 20,000. Okay. So if PQR, which is a subsidiary, is showing a profit of 20,000, right? This profit is something which pertains to the shareholders. And in case of PQR, there are two shareholders, ABC to the extent of 70% and NCI to the extent of 30%. So what are we doing now? We're simply saying that you reduce the profit which pertains to ABC. You reduce the share of profit which pertains to NCI and reduce the value of the inventory as well. So we are just dividing this 20,000 in a 70-30 proportion. And that's something which is expected to be done there, right? So it is not just, for example, the sales and the purchases which are adjusted, right? But also the inventory which is adjusted from the books of the group there, right? That's what we are doing. Reduction in the consolidation, consolidated financial statements of 20,000 rupees has to be allocated between the parent and the NCI, right? In the ratio of 70 and 30. And that's what we have just done a while ago, right? Let's have a look at the other question. It says that now the sale is done by the parent to the subsidiary. In this case, again, you're talking about that the parent's profit shall be reduced and the inventory shall be reduced to the extent of 20,000, apart from the fact that the sales need to be reduced by 50,000 and the purchases also need to be reduced by the same amount, right? Effectively, we are bringing this thought that if your purchases are reducing by 50,000 and your profits are also reducing by 20,000, right? Effectively, your inventories, for example, is 20,000. Effectively, your cost of goods sold is impacted to the extent of 30,000, for example, right? That's broadly, the thought process that you want to carry along. All right, so that's what it's saying. Basically, you're looking at the profit, which is purely the parent's profit. So you don't have to obviously make any adjustment around that part.